Hello, good morning, everyone. Welcome to all of you for today's session. Students, I hope you people can hear me. During this session, we have to interact over here in the chat box. You can ask me question over here or interact me for the issue, whatever you like to raise with me about the lecture and the subject as well. So just let me know whether you people can hear me. Tell me please, can you hear me? All right. All right. Okay, so students, our subject is Advanced Financial Management, AFM. So the subject name is Advanced Financial Management. Students, AFM is very interesting but a bit challenging subject. Means that if you give due time to this subject, you will enjoy it. Let me tell you, you will be loving this subject. But if you skip lectures, if you do not prepare it on a regular basis, it will become a burden for you people. So the first day, in the first thing, I want to be clear with you people that how we need to approach this subject. Now, AFM subject, this subject, we can say it has linkage with F9 financial management that previously you studied in the level 2. And and I know, of course, as well, that it's been long you may have done that subject and you may have forgotten what you have studied over there. So no need to be worried. So no need to be worried. Whatever we will be doing over here, we will be doing from scratch. From just like that, you are doing it for the first time. Now, so let us talk about this syllabus. This subject, this subject can be classified into three major sections. The first section is investment appraisal. An investment appraisal, it is a big portion of your syllabus. Okay, a major portion of your syllabus, investment appraisal. And I say around 40% of syllabus is the investment appraisal, around 40%. And you will see our time, around 40% of the time of the lectures we will spend over here on this subject. Second is, that is risk management. And the risk management, interest rate risk management, currency risk management, both are included in it. And around, I say, 30 to 35% of your syllabus. And the remaining is, that is mergers and acquisitions. And I will include in it corporate corporate reconstruction as well. So it will be taking around 20% of your syllabus. Yes, I am writing this percentage as per the time which we spend on this area of our total lectures. And the last one is some theoretical topics, some like that Islamic finance, just like IMF, World Bank, international financial institutions, and some of the examiner article. So around 5% time will be allocated to that. So, and what we say in exam, in which proportion they are going to be tested. Students, remember, majorly 2, 3, and this is the fourth area. You should expect these three areas can be tested equal, around 20 to 30 marks. They can be tested. And of course, some testing is done from here as well. So it means that there is no space for any selected study. We have to prepare everything. The paper is such a balanced paper. And one thing should be clear from here. From the day first, one thing should be clear. And what is that? That is AFM paper. If you think it is calculation based paper, yes, we do a lot of calculations. But if we see exam paper, so there is around 50-50, that is calculation marks and theoretical questions as well. Means around 50% marks are available for theoretical discussion in the exam. So why students fail their AFM? This is one of the major reason. There are other reasons. That one of the major reason that they spend a whole time in preparing calculations, and they don't spend time to go through the theoretical aspect of the subject. And you will see, I will be analyzing the questions when we will be solving question in the class from the past exam paper. I'll be analyzing that the calculation part, it takes majority of the time of our exam when we are solving this question. Theoretical part, if you have prepared that, it will take smaller portion of the time, but still it is more rewarding in this regard. Less time, more marks. More time, and here you get trapped sometimes because of the complexities caused by the examiner in the question in this regard. So that's why I say from the first lecture, and I say every session, that this should be we should focus it, and we should not ignore it at all, because this is the area which will help you to pass the exam. This is the area. Now, so student, this subject, just like others, three areas, as I told you, three questions are there in the exam. Question number 1 in your paper, that is 50-mark case study, and it can be from any area. Three sections are there, as I told you. It can be from any section. A big case study it will be, but it will have multiple requirements. Of course, it is a combination of two sections, or means one part may be from mergers and acquisitions, the other part may be from investment appraisal, third part may be from the theoretical discussion. So like that mixture. So question 2 and 3, they are most likely to be focused towards one area, most likely. But remember, we cannot say that which pattern examiner, here merger and acquisition or risk or investment appraisal. So we cannot say in which question what is going to be tested. So we have to prepare, and we should be ready for anything which is going to be tested, because once we have prepared the subject appropriately, of course it should not be an issue at all that which area is going to be tested in which question. Now, so students, this is the subject introduction. So any question so far, please, at your side? Any question, anyone from your side? Yes, please. Any question from your side, please? Yes or no? I just want you to be familiar with this process of communication. Yes, I want you to be familiar? Okay, now, because number of you are going to be using this process, this software for the first time. Now, so let us proceed with the first part. So investment appraisal. For investment appraisal is the first section we are going to start. We can classify into three parts. One is that is basic investment appraisal technique, basic techniques to appraise, techniques for investment appraisal. Weighted average cost of capital, that is part of this syllabus, this section. And then international investment appraisal. And Black-Scholes model. So three major sections, this area, three subsections. International investment appraisal or Black-Scholes models. So let us start with the basic investment appraisal techniques. So students, we know that investment appraisal is done by the businesses because they're going to invest a huge amount of money in some project. So they just want to know, they just want to analyze the investment before they proceed, that whether they should go for that investment or not. So they want to just evaluate. They just want to evaluate. So students, investment appraisal, just for techniques. So what are the techniques to appraise investment? So these are my notes. You will be provided with the notes, which include exam practice questions as well. Right. So students, this is the table, annuity table, present value table, which will be given to you in the exam as well. So investment appraisal techniques, yes, they are of two types: discounted cash flow techniques and non-discounting techniques. Non-discounting techniques, yes. Discounting techniques, yes. So non-discounting techniques. So they are in front of you. So payback period method and ARR, accounting rate of return, discounted payback, net present value. So all have been listed here, which are part of our syllabus. So let us start with ARR. First, ARR, accounting rate of return. Accounting rate of return. Student, ARR is basically, this is the only technique which is profit based. Only technique which is profits based. Technique. That's why I corrected over there, that it is profit based technique. Accounting ARR or ROS, return on capital employed, as well, sometime it is a substitute for that. It is equal to estimated average annual profit divided by average investment cross 100. This is the formula. Yes. So cross 100. Now students, in some formulas, you will find initial investment here. Remember, examiner says this is preferable. Average investment is preferable in the formula. For example, a company has earned profits for the year as follows. Yes. So profits of the company are as follows. These are the expected profit of a project. 200 million, 220 million, 420 million, and 320 million. So investment in the project is required is equal to, that is 800 million. And scrap value of the project is, that is equal to 100 million. 200 million. Yes. 200 million. So we need to calculate ARR. How to calculate? Student, average annual profit we can calculate. So average annual profit. We will sum up all these four and divide it by 4. So 200 plus 220 plus 420 plus 320. You should have calculator with your hands. And you will be telling me the calculations. Yes. You will be having calculators in your hands, please. Yes. So it is equal to 290. Yes, 290. Yes, average annual profit, 290. Now, average investment. How to calculate that? Initial investment plus scrap value divided by 2. How did I calculate it? Initial investment plus scrap value divided by 2. So it is equal to 500. Now ARR can be calculated. Average annual profit 290 divided by 500 cross 100. So we simply can calculate that. So 58%. So it is equal to 58%. Students, ARR. Usually companies, board of directors, they decide a target ARR. Usually boards. And for example, if they decide 40%, so we say that if ARR of project is greater than target ARR, so we should accept the project. Or vice versa. If it is less than it, so we should reject the project, or vice versa. Now, students, ARR has this technique has some advantages and disadvantages as well. We must know that. Yes. So the first you see here are the problems, limitations. This is using profit and loss. And profit and loss and the capital employed, so managers are more familiar with it because they are the routine terminology. Okay, now, so of course in the percentage answer is being told, and it is the commonest method of evaluating performance of the business unit. and easy to communicate to shareholders. But there are some drawbacks as well. Let me write some drawbacks of this project, this method as well. Drawbacks. What are the drawbacks of the method of ARR, using ARR? Number one, it is based on profit, which is subject to manipulation. Yes, means that you can increase or decrease profit by increasing or decreasing some judgmental item in the financial statement, depreciation, provisions, and such items. You change those items and you change profit. Drawback. So first drawback is there. It is subject to manipulation. Second, it ignores time value of money. It ignores time value of money. Yes, it is not considering at all. We are just averaging out 4-year profit, just like that. Tomorrow's 200 and today's 200, they are equal. It is ignoring. It is not incorporating at that. And third is, it is relative term. You see, 50% ARR, 25% ARR. Two projects are there. ARR, two projects, project A and project B. This has a total profit of 50 million, this project, but this has total profit of 20 million. Now, if you see, on the basis of ARR, we should select this, but it has total profit less because it is relative term. It is giving answer in percentage. It is not talking about the size of the project, size of the profit. It is not talking about that. It is ignoring that. So when we are making decision on the basis of ARR, we are ignoring all other things. We say ARR higher, select A. But you see, the more chunk, more profit, exact, so it is ignoring that. I hope it is clear. It is clear to you people, relative term. Is it clear, students? Okay, good. Now, let us proceed further. Thank you. Let us proceed further. So ARR is completed. Accounting rate of return. Welcome, welcome, Nafis. Welcome. Okay, now let us proceed further. So the next is payback period method. Whenever you make investment in a business, your first concern will be that by which time my initial money which I am going to put over there, that will be recovered. By which time? How much time it will take? How many years? For example, a project requires initial outflow of 500 million initial investment. And you need to arrange this money from the bank. So your first concern will be, I have to return loan to the bank. After 5 years, for example. Will my project give me 500 million back in 5 years? And will I be able to repay my loan? So this is the first question. If your project is not giving a return within the time you need, equal to initial investment, you may say, okay, I will not accept this project because I am going to take loan from the bank and I'm going to invest over here. and this project is, for example, you get loan for 5 years. Funding, it means you have to repay the amount in 5 year time. So this 500 million you are going to get in 7 years from the project. You cannot accept this project. You cannot go ahead. You say, okay, I cannot do that. I need to return because I will not be able to return the investment. So payback period is, that's why it is called screening method of investment appraisal. It is called screening method of investment appraisal. Means if a project does not fulfill the payback requirement of our project, our funds, we cannot move forward for further evaluation. We cannot move forward because this is the first step. Now, so payback period method, it measures about a project that the time period in which initial investment of a project will be recovered is called payback of the project. It's called payback of the project. It's called payback of the project. Now, next. Students, it is calculated. Payback is cash flow based technique. Only ARR is profit based. All other are cash flows based. Now, what is difference between cash flow and profit? I will talk after some time. After this payback, I'll discuss payback first, and then I'll come back to the payback and cash flow difference. Profit and cash flow difference. So payback. Now, students, cash flows of the project can be even cash flows or uneven cash flows. Even cash flows means that project is to give same cash flow every year. Same cash flow every year. Yes. For example, investment is 800 million investment, and project will be giving cash flow inflow of 160 million every year. So calculate payback of the project. So payback, how to calculate? In this case, is equal to initial investment divided by annual cash flow. Annual cash flow. So 800 million divided by 160 million. So 5 years is the cash payback period of the project. So this project has payback of the 5 year. Students, wherever you face any ambiguity, any issue, do let me know in the chat box. Don't hesitate at all, please. Don't hesitate at all. Feel free to ask question in the chat box immediately. wherever you face any ambiguity. Now, next, uneven cash flows. When each year, and it is more practical because projects do not give same cash flow every year normally. So when uneven cash flows are there, then, so you see here, for example, a project has these cash flows, 800 million initially, 240 million, 280 million, 190 million, 320 million. Now, what is the payback? How to calculate? In this case, we make another column that is called cumulative cash flow column. That is called cumulative cash flow column. Cumulative. Cumulative means total to date. Total to date. So you see here in the first year, year 0, 800 million negative, and then it will be recovered in the first year, and the remaining it will be 560 million negative. Out of 800, 240 recovered, and then 280 recovered. So 280 million remaining. Out of 560, this recovered. Then 190 recovered. So 90 million remaining. It means 3 complete year. And you see here 90, we need how much now? 90. How many there are? 320. It means part of year 4 will be utilized, not year 4 full. Part of year 4. And our amount will be recovered. So payback period will be like that, 3 year plus 3 year full. Remaining we need 90. And in the year are 320. So we simply can calculate it. We simply can calculate it. 90 divided by 320. It is 0.28. 3.28 years. Yes. Thank you. This is the payback period of the project when cash flows are uneven. Now, let us proceed further. Students, if payback of project is less than or equal to required payback, we say accept the project. Accept the project. Now, otherwise reject. If it is higher than that, we say reject the project. Now, students, before discussing the advantages and disadvantages of payback, let us discuss the difference between cash flow and profit. Any one of you can tell me the difference. You may have the idea. What is the difference between the both? Yes, please. Anyone out of you? Yes, please. Exactly. Includes or excludes? Excludes. Okay. When we calculate profit, we exclude, we deduct non-cash item. And then we reach the, when we reach, net profit. How it is calculated? We deduct depreciation, non-provisions, and other non-cash items. So cash flow, what is the relationship? We add back non-cash expense, depreciation, for example. So we calculate cash flow. So profit plus non-cash expense, add back to profit. Then we get the cash flow. So this is the relationship. I hope it is clear. Or if cash flow is given to us and we need to reach profits, so we deduct non-cash expense and then we reach profits. I hope it is clear to you people. Now, if there is any confusion, do let me know. Let us proceed further. So student, payback period method, its advantages and disadvantages. Yes. Students, payback period method, it has, first thing I told you, it is screening device. It is easy to understand. Some drawbacks really need to be considered. Drawbacks, and you need to note down these drawbacks. Yes. Yes. Drawback of using this method. The first drawback is that it does not consider time value of money. You see, it does not consider, because you see here we were treating the same all cash flows in the similar way. Just like that, we didn't discount, we treating all the cash flows similar way. Now, next. Secondly, it leads to excessive investment in short-term projects, because with the payback we say smaller payback, accept it. This is what we are saying. So short-term investments, it actually, we ignore the long-term perspective of the business. We ignore that when we are using payback. We ignore that actually. And very important, it ignores the cash flows arising after payback period. Now this is very important. Or it doesn't consider the whole life of the product. Just see here. Just see here. Two projects, project A and project B. Investment is same, 1,000 million. And second, cash inflows. For example, year 1, 2, 3, 4. So it is giving inflows of 600 million, 400 million, 100 million, 50 million. It is giving same year 1, 2, 3, and 4. 400 million, 500 million, 600 million, Okay, just make it 600 million and just to make her 300 million and 200 million. These both projects have payback of 2 years. You see. Now, which one to choose? They are not talking about what is getting, what we will be getting after payback. Payback is silent about that. When you ask what is the payback, they say, though, 2 years. 2 years. It is not telling us anything what will happen after 2 years. It is not telling us at all. You see, it is giving more. So this is silent. Payback method is silent. That what is the cash flow? Means it does not consider full life of project. Yes. Doesn't consider full life of project. Yes. Now, let us proceed further. Let us proceed further. So payback period is done. So students, now comes the concept of discounting. So you see, I wrote over there discounted cash flow techniques. These are those techniques which basically consider time value of money. Now, what is time value of money? We know that time value of money means that today's $1 has more value than tomorrow's $1. Yes. Why? Because of the following reason. Number one, what is the reason? The first reason is that is inflation. Because of inflation, today $1 has more value. Tomorrow it will be devalued. Secondly, is the opportunity for investment. You will get $1 today and you can invest it and make it double by tomorrow. But if you will be getting $1 tomorrow, that will be $1. If you get today, you can invest it somewhere. You can invest it. And the third one is, that is risk or uncertainty. It is for sure you are getting now $1, but will you get tomorrow? Tomorrow is uncertain. So these are the three reasons because of which time value of money exists. Because of which time value of money exists. So discounting and compounding. Discounting. So there is concept of discounting, that we get present values. We know that discount factor. Students, basically, for example, you have 100 rupees today and you invest it at 10%. So after 1 year, what you will get? You will get 110 if you solve it. Today 100, you invested at 10% and you will get after 1 year 110. Just see here. I take 100 common in both of this and this. So it will be 1 plus 10%, 110. Is it clear? This one? Simple math rule from school level. Is it clear to everyone? I took common 100 from both of these. Now you just see here. So students, this is the amount you are going to invest today, 100, present value. This is the rate at which you are going to invest. This is the amount you will get tomorrow, future value. Future value. So we have, you see, derived a formula. If you are going to invest for 1 year, its power will be 1. If you are going to invest for, just a minute, please, just a minute. Listen, please, everyone. Listen, please, everyone. If you have any problem, such like that, which a student face right now, or sometimes you get emergency, because of the home, your commitment, family commitment, or some other work-related commitment, remember, we will be providing all the video recording to you people of all lectures, which means you can watch at home yourself again and again. Okay, so that you will be using at home. All right, so you need not to be worried about that. Okay, now, so if it has power, if it is for 1 year, its power will be 1. If it is for 2 years, its power will be 2. It's for n year, its power will be n. Of course, notes as well. Once you people get registered, because majority of you are on trial basis today, so during the coming week, the soft copy of the notes will be shared with those who get enrolled. Okay, that will be shared with them. Right. So you see here, present value is equal to future value divided by 1 plus r raised to power n. So present value is equal to future value into 1 plus r raised to power minus n. So this is the factor which convert future value into present value. This is called discount factor. Discount factor, 1 plus r raised to power minus n. And you know, a formula, you need to, of course, you should know this formula, but you will be given discount table in the exam, okay, which you can utilize and you can solve your question by using that table. Now, so students, discount factor is used to convert any amount of future in today's value. In today's worth, discount factor is used. Present value factor, it is also called. It is also called present value factor. Now, next. So students, now we are going to discuss discounting. So for the payback period method, we discuss a drawback that it does not consider time value of money. So then came the concept of discounted payback. Discounted payback. What is discounted payback? Similar like payback, you see here 2, 3, 4. For example, these are the cash flows: 500 million, 200 million, 150 million, and 180 million, and 200 million again. Students, calculate payback, simple payback, every one of you, and give me its answer. The payback we learned a few minutes ago. Calculate payback of the project. Be quick and tell me the answer. Be quick, please. 500 million, it is return investment 2.17. 2.8. All right, 2.83. 2.83 is correct. Exactly, 2.83 is correct. $2.83. Now, for example, discount factor R is 10%. So we will write discount factor here at 10%. So 1.909, 826, 0.751, 0.683. You will now multiply these discount factors with and calculate present values. Yes, you will calculate present values. 500 negative, 182. It is 124. Rounded figure I'm writing. 135. 137. Now, so these are the present values. Because we are going to calculate discounted payback, so first of all, we need to calculate present values. Now, cumulative cash flow column. Yes. Cumulative cash flow column will make. So 500, 182 recovered, 318 negative remaining. And out of 318, 182, yes, minus 124, sorry, 124 recovered. Remaining is 194. Then 135 recovered. 59 remaining. So 3 year complete. And a portion of year 4. It is 3.43 years. So discounted payback is, you see, simple payback was this. This was a simple payback. You calculated. And this is the discounted payback. You see, discounted payback considered time value of money. That's why real terms, what is the total amount recovered? So that's why we can conclude over here, discounted payback is always greater than simple payback of a project. Of a project. We conclude that. So time value of money has been incorporated. Now, students, so one problem of the payback period is resolved. You see, if you come here, this is resolved. This problem is resolved. Now comes the turn of it, that it doesn't, you see, It ignores the cash flows. It doesn't consider the full cash flows of the project. So there should be, it is still remaining behind. It is still remaining behind. Same problem here. It ignores the cash flow after the payback period. So only one problem resolved, which was basically time value of money. The second problem is here, still here. So there come the concept of duration. Duration. So duration basically it is weighted average time to recover cash flows of project. Weighted average time. How? Now what is the meaning of it? Let us learn it by example. For example, a project has cash flows as follows. $750 million, and positive cash flows are 170 million, 210 million, 320 million, and 330 million. And the fifth as well, 350 million. Now, for example, discount rate is still 10%. Remember, we are going to learn how to calculate duration. Focus please everyone. First of all, what we will see, students, this is basically return phase. It is investment, it is return phase, from which return is starting of the project. So we calculate present value of return phase by applying discount factor at the rate of 10%. So 0.909. Now, so we will calculate present values. It is 154 210 cross 0.826, 173, 240, 225, 217. Now, student, the first step is step 1. I will write here. Step 1, which we have done. Calculate present values of return phase. So what is the total sum of this? Sum of return phase. So 154 plus 173 plus 240. God. Just a minute, please. What happened to it? Okay. So the sum of the present values of return phase only, ignoring this, remember, It is 1009. 1009. Now, step 2. Divide each present value. I am writing these steps just to make you understand. In exam, you don't have to write. You have to simply calculate. Remember, in exam, you have not to write in words. Divide each year present value with total present value of cash flows. Means this will be this will be divided by this. This will be divided by this. Yes, simply. So now, just see here. So 154 divided by 1009. It is 0.153. 173 divided by 1009. 0.171. 240 divided by 1009. 0.238. 0.223. And the last one, 217 divided by 1009. 0.215. Students, up till now, is it clear what I have done? Tell me, is it clear up till now? Good then. Good then. Now, next. Now, students, step number 3. So, step 3 is multiply each fraction which we have calculated with relevant number of year. For example, this multiplied by 1 number of year. This multiplied by number of year. This multiplied by relevant number of year. In this way, 4 relevant number of year. So we will multiply, it will be 0.153, and here it will be 0.171 multiplied by 2. Relevant year is 2. 0.342. 0.238 multiplied by number of year 3. Just 238 cross 3. 0.714. So 0.223 cross 4. 0.892. And the last one, 0.215 cross 5. Number of year 5. 1.075. Step number 4. Add all results to get duration. Now you see here. So 0.153 plus 0.342 plus 0.714 plus 0.892 plus 1.075. So 3.176. This is duration of the project. So weighted average, you see, we have done weighted average. Time to recover cash flows of the project. This is called duration. So it is covering the whole life of project. It is incorporating discounting as well. Duration. I will repeat once again. First of all, we calculated present values of the return phase. You just can see. Present values of the return phase. We calculated. We got the total of all that. Then divided each year present value with the total present value. We got fractions. And then we multiplied each item with the relevant number of year. So we got this amount. And the sum of all these is, that is duration. So weighted average time to, yes. So then duration have the drawback. It is difficult to conceptualize, difficult to understand. The only drawback. Yes, it is difficult to understand by business, yes, businessman, for business managers, for business manager. Yes, because it is a bit complex matter. So you see here, its advantages, considering time value of money as well as the whole life of the project. I hope it is clear to you people. Now students, it is a time for a short break of around 15 minutes. You take some break. We will be back after break and we will continue with the next method of investment appraisal, that is net present value. So time for the break. See you after 15 minutes. Yes, students. I hope you people are back. All of you are back. I hope. Now, are you there? Please tell me. Are you there? All right. All right. So, students, our next topic is net present value. NPV. Net present value of investment appraisal. It tells us that NPV, it tells exact impact of a project on shareholders' wealth. Exact impact of a project on shareholders' wealth. Students, what is the meaning of it? I will explain in a while. NPV is equal to present value of cash inflows minus present value of cash outflow. Students, let us learn it by an example. So this is the cash flow and its project, a project and its cash flows 1000, 400, 300, 420 and 350. Now discount factor is 10%, so we will apply 0.909, 0.826, 0.683. So we will calculate its present value and NPVs as well. So 1000 present value is here. Now, calculator. I'll open. Yes, let me open it here. Yes. 400 cross 0.909. 364. All right. Yes. Then 300 cross 0.826. Sorry, 300 cross 0.826. It is equal to 248. Next, 420 cross 0.751. 315. And the last one is 350 cross 0.683. 239. So now this is the negative. So NPV will be the net of it. Sum and this deducted. We can calculate plus 315. Sorry, 315 plus 248 plus, oh my God, 364. Yes, minus 1000. It is 166. 166. 166 positive. You see here, the project, how much was investment? 1000. This will be the cash flows given. We deducted cost of capital by discounting, got present value. We paid off initial investment. Still in our bank account, we have 166. So shareholders' wealth of the company's shareholders' wealth has increased by 166. In other words, for example, they borrowed 1,000 from a bank. They invested cash flows. They paid, first of all, cost of capital. Then they repaid bank. And still with them, the remaining amount is this in the pocket, positive 166. So NPV is positive, which means shareholders' wealth has been increased. So increased by this amount. So accept the project. Students, this sentence is clear. How wealth has increased by positive NPV? Is it clear? Or should I elaborate again? How wealth has increased by 166? Is it clear? Good. Good. Now, student, if NPV is negative, for example, if NPV of project is negative, it means that it is loss. Project is causing loss to the shareholders' wealth. That is, shareholders' wealth has been decreased. Yes, reject the project. Means negative means you are now paying out of your pocket. You invested by using the project financing. You finance the project. You paid the cost, but now project is unable to pay initial investment even. So negative NPV. Negative NPV. Now, next. Next is IRR, internal rate of return. Student, before proceeding with that, NPVs, we can discuss NPVs advantages. A very good, a very sound method of appraisal it is. It considers time value of money. Yes. It is based on cash flows. Cash flows. Students, NPV considers full life of project. Full life. It is absolute measure. Now, what is the meaning of absolute measure? Means it tells the exact impact. That is, tells exact amount by which wealth of shareholders will be affected. Tells the exact amount by which shareholders' wealth will be affected. Exact amount, you see. This is exact amount. Shareholders' wealth has been increased by 166 million. Exact amount. Absolute. So preferable. It is preferable. One more thing. One more thing. Very realistic assumption. It assumes that cash flows from project are reinvested at cost of capital, which is a realistic assumption. Just note down, I will explain it when I will be discussing IRR in a while. Just note it down. This I will explain when I will be explaining IRR, internal rate of return. Now, next. So the next method is internal rate of return. IRR. Internal rate of return. Students, IRR is basically a concept. The definition is basically the definition which we study. I do not like that definition too much, but I will write that the rate at which NPV of project becomes zero. Students, before I explain it, come back to it, please. Here, one more. This is very important point. Let me tell you, very important and very conceptual, and wonderful point. By discounting, what we are doing actually? By discounting, when we are doing discounting, what we are doing actually? We are basically deducting cost of capital. We are incorporating time value of money, opportunity for investment. We are deducting it. The cost of funds, opportunity cost of funds, we are deducting it. So by the IRR has another definition which I developed. Basically, you need not to write that in exam, but for your understanding, this is my own, what you can say, my own interpretation of IRR, that it is basically IRR is percentage return, annual percentage return in the form of cash flows considering time value of money from a project. In the books, you will find this definition only, not this one. Now, I will prove it how it is. I will prove it, this definition as well, so for understanding. And actually, in practice, we are utilizing this more. Now, just see here, IRR, how it is calculated. IRR, internal rate of return, is equal to, again, low rate of return plus NPV at low rate divided by NPV at low rate minus NPV at higher rate into higher rate minus lower rate. This is how IRR is calculated. This is how IRR is calculated. Now, let us proceed. Let us proceed. For example, the same, I will take the same example, which is here. We calculated NPV here. Same cash flows. Yes. So NPV at 10%, it has been calculated 166. Just a minute, please. Just give me 1 minute. Yes, I will take its picture and will take it over there. So we have calculated NPV at 10%, same cash flows. NPV at 10%, which was 166 positive. Now, so the cash flows are here 0, 1, 2, 3, and 4. 400, 300, 420, 350, and initially 1000. So it's NPV at 10% we have calculated. So NPV discount factor at the rate of 15%. Let us put that discount factor from notes at 15%. Yes. Now, so 0.1 for year 0, 0.870, 0.756, 0.658, and 0.572. Now, we will apply these discount factors now and calculate another present value. Now, 1000 negative. So 400 cross 0.870, 348. 300 cross 0.756, 227. 420 cross 0.756. 318. 350 cross 0.572. It is 200. So NPV at 15%. Fourth one is not good. Okay, let me check, please. 350 cross. It is 200. Okay, 3. 420 cross 0.658. 276. Yes, you are right. You are right. It is 276. Yes. Thank you. Now, NPV. Positive 51. Positive 51. Positive 51. Now, at 15%. Now, we will be applying formula IRR. We have low rate of return 10%. NPV at low rate 166. Yes. 166. divided by 160 is NPV at low rate minus NPV at higher rate. Higher rate minus low rate. Student, tell me its answer. Be quick. Solve it and tell me its answer. IRR. Be quick, please. Exactly 17. I have calculated myself. 17.2% IRR. Now focus please. The point which I want to explain. What is the meaning of this IRR 17.2%? The meaning is that this project is yielding this annual percentage return. This is the return from the project. This is the return from the project. You see, annual percentage return. If you deduct this return from the project cash flow, NPV will become zero. Now you see this definition as well. If you deduct, mean you discount these cash flow at this rate, NPV will become, so the both definitions verified. 17.2% is the yield, return from the project. If you deduct that return, NPV will become zero. Because remaining is only cash flow equal to project initial investment, because it is total return, annual return. Is that clear, students? Tell me please, is that clear? Now next, thank you. 17.2% we got. No issue, I can explain. 17.2%, what is it? It is return from the project. Means project is yielding 17.2% every year. 17.2%. This is the meaning of it. And if we deduct this return from these cash flows, when you deduct return, what remains behind? Investment. If you minus all the return, what remains behind? Investment. So NPV is equal to zero. If you deduct return from cash flows, those cash flow will become equal to investment only. So NPV will become zero. Is it clear now? Okay, good. You're welcome. Now, next. Students, IRR, it has drawbacks, and those drawbacks are very much important. Advantage is same. Consider time value of money, cash flow based. How much it is? How much did you get? How much did you get? Yes, Nifaz. How much you get? Tell me, please. No, it is correct. I have checked once again. It is exactly same. Now it is about calculator and calculation. It is exactly same. I have checked again. Verified again. So Oh man, calculator now. It is just, oh my God. Now you see here. I feel like divided by, yes, 166 minus 51 equal sign, okay, multiplied by 5, 7.2 plus 10. Here it is. Is it clear now? Man, now you see. Uh, anyways, now let us proceed. So drawbacks. Drawback. Advantage is same. It is cash flow based. Consider time value of money. Considers the whole project. Drawback is that, again, it is a relative term. Drawbacks of this method. Relative gives answer in percentage. Now, so NPV method is preferred over it as NPV gives absolute answer, gives result in absolute terms. Now I will explain it. Just see here. A project A and project B, IRR, they have IRR 10% and 15%. NPV 320 million and 170 million. Now if we choose on the basis of IRR, we should select this. If we choose on the basis of NPV, now students, so which one is preferred then? NPV, by NPV wealth is increased 320 million. So NPV is preferred because it is telling the exact impact on the wealth. Now, second, for non-conventional cash flows, multiple IRRs are generated sometimes. Now, what is the meaning of it? Multiple IRRs are generated sometime. Now, just see here. First of all, what is non-conventional cash flow? Conventional cash flow is the initial outflow and then inflow every year. This is conventional. What is non-conventional? Initial outflow, then inflow, then outflow, then inflow, then outflow, then negative cash flows. Yes. Just a minute, please. My God. Yes. So non-conventional, multiple times outflows where there are. So non-conventional cash flows. When we apply IRR formula using spreadsheet, not the manual calculator, using spreadsheet, sometimes it gives two IRRs. For example, it give IRR in this way, 19% and 39%. Remember, IRR, how to evaluate IRR? If we say if IRR is greater than cost of capital, we should accept the project. Or vice versa. If it is less than that, it means that return is higher than cost, accept. If return is less than cost, we should not accept, because that is loss then. Now, students, if cost of capital is 25%, now tell me whether we should accept this project X or not, for which we have got these IRRs. Tell me, if cost of capital is, yes, tell me. I'm waiting for your answer. Exactly, it is difficult to tell, because we cannot say if we consider 39% we should accept, if we consider 19% we should not accept. So this is the drawback. So unable to decide, IRR drawback. Now, next, third, IRR assumes that cash flows of project are reinvested at a rate of return equal to IRR, which is not possible if IRR of a project is too high. Note it down. Similar point which I told you about NPV a few minutes ago. Now I'll explain. Now, just focus now. These are the cash flows of the project. For example, a project is giving IRR of 40%. High return. For example, this project. IRR assumes that when you get this cash flow in the first year, you again can reinvest for the remaining life of the project at 40%. The next year you get this, again you can reinvest somewhere else this amount at 40%, same rate of IRR. Same. And you know that it sometime it happens if a project has a very good return, abnormal return, you may not find similar project with the similar returns where you can invest your surplus cash. We are getting the surplus cash of the project. We may not find some other opportunity to invest this cash at the same rate of return if IRR is too high. Yes, if cost of capital is 15%, for example, and okay, if IRR is 17%, we may find some other place at 17% because it is the average return, not too abnormal. So when we are getting abnormal return from a project, we may not invest those surplus cash flows somewhere else at the same rate. But IRR assumes that we can invest. So IRR assumption is wrong. When it becomes wrong, if IRR of a project is too high, we may not find a similar project to invest those same cash flow at the same rate. Is this point clear? All right. Now come to the same, the point of NPV. NPV assumes that cash flows of project are reinvested at cost of capital. Cost of capital is a lower rate, so which is realistic. So assumption by cost NPV is more realistic as compared to IRR. It is more realistic. Reinvestment assumption, we call it. So reinvestment assumption of IRR is it becomes wrong when IRR is too high as compared to cost of capital, which has realistic assumption, which has realistic assumptions. Now, next. Next, let us proceed further. Let us proceed further. Students, we should know, we should have knowledge and concept of IRR, that how it is being calculated. You see, this is the graph. Here is discount rate, cost of capital, yes, rate R, and here is NPV. We got, for example, first NPV positive, one rate, and another rate that was also positive, if you remember. Both were positive. So this is NPV at lower rate. This is NPV at higher rate. Both were positive. So how we calculate IRR? In this way. At this place, NPV is 0. And this rate, whatever it is, this is IRR. You see, this is IRR. What we did, we found this process is called extrapolation. Means finding a point beyond 2 points is called extrapolation. So we did extrapolation. You see here, we had 2 points and we found a third point beyond 2 points. So this is IRR. Second case. Second case. Yes. R. It might be possible that at two rates you get both NPVs negative. So NPV, so this is negative and another negative. This is NPV at a higher rate. This is so just joining this. So this is the point at which NPV is 0. This is IRR. Again, extrapolation. Finding a point beyond 2 points. Again, extrapolation. Friend, these two graphs are clear to you people. How IRR is found? These two graphs are clear. Good. Now, third graph. It might be possible, and which is better, it is better as well, that one NPV is positive and one is negative. So NPV at low rate, it is positive. NPV at higher rate, it is negative. So what we do, we join these 2 points. Yes. Yes. This is the point. This is IRR. It is called interpolation. Finding a point between 2 points. Between 2 points. Finding a point between 2 points is called interpolation. So IRR. Now, next. So in whether you get two NPVs positive or negative, or one positive, one negative, simply apply the formula, your answer will be okay. So I have proven that in 3 ways IRR can be calculated. All 3 will be valid. Now students, there is another topic, that is MIRR. I am not going to teach that today. That will be done in the next class, MIRR. Now today I will be discussing annuity and perpetuity, and that will take, I think, 30 minutes around, and that will be our last topic, annuity and perpetuity. Students, for the time being, we have learned discount factor. 1, 2, 3, and 4. That you get this amount and you need to calculate present value 10%. Simply apply discount factor. And you get present value and the sum of all these. So your discount factor is applied on single amounts. You see, single amount with each. And of course, calculation becomes lengthy. So there is a shortcut as well. That is called annuity factor. We need to study. What is annuity? Annuity is basically a series of cash flow with, number 1, constant amount. Second, at constant interval. And the third one is for limited period of time, limited known period of time. That is called annuity. And how present value of annuity is calculated? Annual cash flow multiplied by annuity factor. Annuity table will be provided to you in the exam for n number of cash flows, n for number of cash flows, n for number of cash flows. Now, so 700, same example. Okay, I will take here. We said 1, 2, 3, and 4, 700 every year. So present value. So constant amount, same amount at constant interval for known period of time. 700 cross 10% annuity factor, and n means, remember, number of cash flows. Remember, number of cash flows. Now, so four cash flows. So simply we will go to the annuity table. Here is the annuity table. 10%, for example, is the rate 3.170. 4. So 3.170. We will multiply it and get the same answer which we apply through the discount factor. Now, so 700 cross 2219. Now, student, annuity is of three types. One is called simple annuity, annuity due or in advance, both name. And the third one is deferred or delayed annuity. So one by one. Simple annuity, where cash flow starts in year one. Just like we solved, cash flow starts in year one. And we have learned that how to calculate its present value. Annual cash flow cross, yes, annuity factor. Now annuity due, what is it? Yes, what is it? Where cash flow starts from now or from year zero. For example, 0, 1, 2, 3, and 4. Yes. No, cash flow starting now. Students, if we forget this, for example, forget this. This is simple annuity. This is simple annuity. So for this we know annual cash flow cross annuity factor, same formula. So it is easy. For year zero, we know discount factor is 1. Discount factor is always 1. At every rate is equal to 1. So 1 plus, so you see here, annual cash flow cross 1 plus annuity factor, that is equal to present value. So what we have to do, I told you that, yes, Ignore this for the time being. So this formula, now we cannot ignore because there is an amount for year 0. Discount factor is always 1. So 1 plus annuity factor for the remaining. So now, yes, just see here. So annual cash flow 700 cross 1 plus annuity factor for this simple annuity factor 3.170 we know at 10%. Yes. So simple we can multiply it. Yes. Now that is 2719. Sorry, 2919. 2919. Is it clear? Annuity due is clear to everyone? Tell me. Now, next. Delayed or deferred annuity. What is it for? Delayed or deferred annuity means where cash flows start after year 1. For example, it is starting from here. From year 4 or year 3 or year 2, not year 1. After year 1, deferred or delayed. So then if we forget this, again, if we forget this is year 1 and this is year 0. So this is year 2, this is year 3, year 4, year 5. So this is simple annuity. If we forget that for the time being. So for this formula is present value is equal to annual cash flow cross annuity factor. Simple. So answer will fall over here. Answer will fall over here. Is it or not? Answer will fall over here. Year 0. So let me solve it. So 700 cross annuity factor are 10% for 5 years. 5 cash flows. 1, 2, 3, 4, 5. 5 cash flows. So it is 3.791. 3.791. So just see here. So 700 cross 3.791. It is 2654. But this answer is falling here. But if we see, this is not year 0. This is year 3. So 2654 is falling here. Now we have to take it to year 0. And in order to take it to year 0, we need to, now this is single amount. This one amount, cross discount factor for 3 years at 10%. Cross discount factor 7.751 at 10%. Cross 0.751. So we can solve it. Simple. Cross 0.751. It is 1193. 1993, sorry. Yes, this is the answer. I repeat. Initially, we assumed that, yes, this is simple annuity. So we applied formula for simple annuity. Yes, simple annuity formula. So answer will fall here in year 0. But that is actually year 3. That is not year 0. That is actually year 3. We have to take that single amount of answer in year 0. So multiply with that, the discount factor. So because it was year 3, so 3-year discount factor applied, and we got the answer. Is that clear to everyone? Delayed or deferred annuity? Now, next. What about others? People are silent. What happened? Is it clear to everyone? Yes, please. If there is any confusion, do let me know. Good. Thank you. Thank you. So student, annuity is done. So 3 types of annuity we did. 3 types of annuities we did. Now, we will be moving forward with the perpetuity. Perpetuity. Perpetuity is also series of cash flow with number 1, constant amount at constant interval for unlimited period of time. Unlimited, indefinite, unlimited period of time for the foreseeable future. Now, for example, students, you are getting cash flows 700 from next year and in the foreseeable future every year. R is equal to 10%. So perpetuity, indefinite period. So present value is equal to annual cash flow 1 over R. This is perpetuity factor. I can tell its calculation with you, that how it is derived, but that is not part of our syllabus. Not testable in exam, that how it is derived 1 over R. I can tell you, even I can prove that, but not required, not needed. R is equal to 10%. So 700 into 1 over 0.1, 7,000. Present value of perpetuity. So the formula is present value is equal to annual cash flow into 1 over R. Perpetuity is of 4 types. Perpetuity is of 4 types in our syllabus. Simple perpetuity, again perpetuity due or advance, deferred or delayed perpetuity, and perpetuity with growth. Although annuity with growth is also part of our syllabus, but annuity with growth, the formula is always given in the exam. That's why I have not discussed that. Whenever annuity with growth will be tested, they will give you a formula in the formula sheet or at the end of the question. That's why I didn't discuss annuity with growth. Okay, so we will be discussing that when we'll be doing a question, because it is already part of a question, annuity with growth. So now Simple perpetuity, where cash flow starts from year one. And we have discussed the same above. Same we have discussed here. Year one. Now perpetuity due, where cash flow starts from year zero. Just see here, 0, 1, 2, 3, and 4. 700, 700, and up to perpetuity. Again, same thing. Forget it. This is simple perpetuity. So present value is equal to annual cash flow cross 1 over R, perpetuity factor. For year 0, but it is here. But it is here. For year 0, discount factor is 1. 1 plus 1 over R. So R is equal to 10%. So 700 plus 1 plus 1 over R. You will solve it. It is 7700 answer. Perpetuity due. Same as that of annuity. So the next is deferred or delayed perpetuity. Deferred or delayed perpetuity. Now, again, where cash flow starts after year 1. So for example, make it from year 3. Student, again the same thing. Forget it. It is year 1. So this is simple perpetuity. So annual cash flow into 1 over R. But it will fall here year 0. But this is year 2. Cross discount factor equal to present value. So you see here 700 cross 1 over R 0.1, 2-year discount factor because it is falling year 2, 0.826, and you can solve it very easily. Yes. $5,782. Present value of deferred or delayed perpetuity. Is it clear so far? Then I will discuss. If it is clear, tell me so that I can proceed to solve the last thing to be done today. That is deferred or delayed perpetuity. Tell me, please. Good. So the last one is, thank you. The last one is, that is perpetuity with growth. Students, I will solve it with a scenario. You are told that you will be getting 700 in next year and amount will grow by 4% per annum in the foreseeable future. Now, you see here, R is 10%. 1, 2, and in the next year, you will be getting 700 and it will be growing by 4% per year. Now, how to solve it? So you see here, we know that present value is equal to annual cash flow cross normal formula. So what will be the formula for it? CF1. Remember, cross 1 over R minus G. CF1 is equal to cash flow in the first year of perpetuity. G is equal to growth rate. G is equal to growth rate. So CF1 700 over 0.1 minus 0.04. So let us solve it. Yes. 700 divided by 0.06. 11,666. 667. This is the answer. This is one scenario. Another scenario. So you can write this formula in this way as well. CF1 over R minus G. Same. The other scenario. You have received 700 recently, and from next year it will grow by 4% per annum. Calculate in the foreseeable future, sorry. In the foreseeable future. Calculate present value of future cash flows at R is equal to 10%. Now, you see the difference between the two statements. We have received recently, calculate present value of future cash flows. We know the formula is present value is equal to CF1 R minus G. So CF1. So next year you do not have, they say you have received this year 700. So we need to calculate CF1 is equal to CF naught into 1 plus G. It will grow from next year by 4%. So CF naught is current cash flow. Current cash flow. Current cash flow. Or cash flow before start of perpetuity. Both names. CF naught, G is the growth rate. So simply that. So the formula will become here CF naught into 1 plus G over R minus G. So CF naught 700 into 1 plus 0.04. 0.1 minus 0.04. Here will be the present value. Yes. So we can calculate it here. 700 multiplied by 1.04 divided by 0.06. 12,133. Yes. You see the difference between the both scenarios. Shouldn't do this mistake in exam that they are unable to differentiate. Here perpetuity is starting from next year. They have given you current year cash flow before. So next year cash flow we need to calculate. And here they have said you in the next year, starting from the next year. So we need to understand and apply it appropriately. Is that clear, students? So in the next class, what we will be doing, let me tell you. In the next class, we will be doing MIRR. First of all, IRR we have done. MIR we will be doing? We'll be doing impact of taxation, inflation, and working capital on discounted cash flow pro forma. Second. Third, we will be solving one past exam question. Okay, and if we will have time, we will start weighted average cost of capital. This is the target for next year. We will start it then. Okay, one past exam question as well we'll be doing. Any question from your side? Today's lecture is over. I have done whatever I had planned for today. Yes, any question from your side? Students, get enrolled. One or two, those people who have already paid the fee, no issue. But the remaining people, you need to get enrolled. Contact me via WhatsApp. We will share with you the payment method and enrollment method 771. Yes, 6644. Yes, and then of course, I will tell over there. Okay, it will be told. Yes, notes can be printed. Of course, you will be given notes. You can print that. Of course. Okay, of course you will get. All right, that's it for today. Remember one more thing. Initially, in the first 2 months, we will be having one class per week. And let me tell you, guys, I'm going to tell this. Yes, Sundays. Initially, it is on Sundays only. But from the third month, 4 months, for example, September and October, we need to conduct an additional class per week because syllabus is big. And good thing is, we will decide, of course, by mutual consensus for additional class. Good thing is, you will be getting video recording for all session. And I hope you will keep those confidential. Okay. So that's it for today. See you next Sunday. Goodbye. Goodbye. See you. Goodbye. Thank you.